我最担心的事情还是发生了。
Hey, what I fear the most has happened. I got an email early this morning from a U.S. client who purchases several $million worth of goods each year. Due to changes in Trump's tariff policies, they'll indefinitely suspend their orders. I read it and nearly passed out. What do we do now?
今年50%以上的工厂都会倒闭。
More than 50% of factories will close this year. The golden era, when machines were running nonstop, is over. My brother, I just got off the phone with a client. He's gone bankrupt and has cleared out his stock. A lot of my clients in my WeChat moments are gone now. My peers are desperately slashing prices and extending payment terms. We have orders with payment terms, but we can't collect the money. Those doing cash sales can't even get orders. The United States' recent increase in comprehensive tariffs on Chinese goods has reached 54%, with plans to implement reciprocal tariffs on multiple countries. Combined with potential port docking fees, this is having a significant impact on Chinese ports and the shipping industry, which rely heavily on U.S.-China trade.
国内港口近期出现异常景象。
There has been an unusual scene at domestic ports recently, with empty containers piling up like mountains, reaching a historic high with 7 layers stacked. This phenomenon has attracted wide attention because 7 layers is the limit for stacking empty containers. Taking Ningbo Port as an example, the empty containers are lined up like a long, winding Great Wall of China. At the same time, around 20,000 truck drivers are facing a situation where they have no goods to transport. The once popular US West Coast route has seen its prices drop by 90%, now only at $3,000. Parking lots at the ports are full of empty trucks.
The announcement of the 54% tariff on China has deeply affected the foreign trade community. At the same time, container cranes at Shenzhen Yantian Port have ceased operations, and vendors at Yiwu Small Commodities Market are receiving numerous cancellation alerts on their phones. In a toy factory in Hojie, Dongguan, factory manager Li Guofu trembled as he read an email from a U.S. client. All Christmas orders are canceled effective immediately. Li, who has been in the business for 20 years, had just invested 3 million yuan to upgrade his small production line. The financial report handed to him by the CFO was even more alarming. If the tariffs are implemented, the price of stuffed toys exported to the U.S. would rise from $3 to $4.60. Walmart would prefer to find a $1.50 alternative from Bangladesh. At 3 a.m., the sound of trucks reversing echoed through the factory. 17 containers of raw materials were being urgently returned. Other foreign trade businesses are also facing challenges. Nanchang Jiayang Apparel issued an announcement. Due to the tariffs, our shipping costs have increased significantly. We cannot bear this, so we have decided that suppliers will share 5% of the tariff for all orders not yet shipped. A kitchenware factory owner in Jinhua, Zhejiang, expresses concerns. The U.S. tariffs have disrupted my plans. So many goods cannot be shipped due to the tariffs and are now piling up in the warehouse. At Ningbo Zhoushan Port, containers are stacked high, and a freight forwarder, Xiao Wang, remarked bitterly as he flipped through empty booking slips. Shipping rates from the U.S. route have dropped from $3,000 to $800, and no one is asking. The most concerning data comes from China Customs. Within 24 hours of the tariff news, the number of canceled U.S.-China route sailings reached a historic peak, equivalent to the loss of 24,000 containers per day. At Shenzhen Shiko Port, a 30-year veteran of scheduling pointed to the deserted berths. I've never seen this scene, not even during the 2008 financial crisis. It's quieter here than a nursing home now. Due to the tariffs, many businesses have chosen to reduce or suspend exports, resulting in a significant decline in cargo volumes. The decrease in shipments to the U.S. has particularly affected shipping companies that rely on this market. A social media user wrote on April 5th, "The shipping industry is the first to suffer from shrinking trade volumes. Companies like Costco Shipping, which rely on global freight, suddenly find their orders disappearing." A freight forwarder friend told me that containers at Shanghai port are piling up, and shipping companies are offering buy one, get one free shipping rates to attract cargo. The downturn in shipping is directly causing a sharp drop in fuel demand. Previously, a container ship running to the U.S. would burn several thousand tons of heavy fuel, but now the ships are stuck, and no one needs that fuel anymore. Morgan Stanley analysts wrote that the increase in tariffs is a significant barrier to global trade and a negative factor for the basic demand in the freight industry. They believe that container shipping companies are most severely affected. These companies use an asset-intensive business model, and fluctuations in shipping rates have a considerable impact on their operational leverage, with rates directly influenced by supply and demand. Since the US-China trade war began in 2018, transshipment trade has gradually become an important strategy for companies facing international trade restrictions. However, as the US announces its most extensive tariff measures to date, it has also increased checks on transshipped goods. A Weibo blogger with a username Kevin in New York posted, "A friend who works in customs at New York airport told me that today they cleared several containers from Israel, but they were selected for inspection by US Customs. The Israeli company, which has a good track record and had never been inspected before, was found to have declared cabinets that were transshipped from China to the US and now needs to pay additional taxes." The impact of the US tariff policy on the container shipping market is significant. Messages from multiple social media platforms show that Ningbo Zhoushan Port, Shanghai Port, and Shenzhen Shirkou, empty containers are piling up. Shipping rates have dropped, and sailings have been canceled. This indicates that the sharp decrease in export orders is quickly transmitting through the logistics chain. The direct cause of this phenomenon is a surge in export costs due to the tariffs, with many Chinese companies being forced to cancel goods that have already been loaded onto ships. According to Taiwanese media ET Today, on April 3rd, a senior executive from one of the 5 largest global freight companies for the Asia-US route pointed out that due to Trump's announcement of reciprocal tariffs, which were much higher than expected, the company had received notices from overseas stations that many containers loaded in China have been canceled for export. Many companies in Vietnam also notified their clients to cancel shipments. It is estimated that in the coming days, a large number of shipments to the US will be canceled, and the impact on the container shipping market will be severe. Now, it remains to be seen whether Trump's visit to China at the end of April will bring any breakthroughs. The company noted that Vietnam originally estimated tariffs to be between 25 and 30%, but they reached as high as 46%, and the only option now is to suspend shipments. The company has already asked Asian stations to investigate the tariff response plans of the top 15 local clients. It is estimated that cargo volume will drop by 30 to 40%, and market shipping rates will be significantly reduced. However, shipping companies are cutting sailings sharply. One East Coast route that had 2 weekly sailings is now reduced to 1, and another that had 2 weekly sailings will now only have 1 every other week. The chairman of another non-listed freight company with annual revenues of over 10 billion yuan said that the impact of reciprocal tariffs will likely be substantial. The internal discussion in the company is that, while Trump has announced the tariff figures for various countries, the specific implementation details are still unclear, and the current situation is chaotic. Customers are unable to adjust in time and may temporarily adjust their shipments. Goods that are already at sea are likely to cause heavy losses for U.S. importers, and U.S. routes will see a significant reduction in cargo for some time until new rules emerge and the market gradually recovers. Trump's reciprocal tariff plan has indeed had negative effects on China's exports and the shipping industry. The U.S.-China route is a critical part of China's shipping industry, and the decline in cargo volume will lead to excess container shipping capacity, falling freight rates, and shrinking profit margins for logistics companies. Some shipping companies may even face insolvency. Southeast Asia has become a heavily impacted area due to the U.S. reciprocal tariffs. For Chinese companies relying on U.S.-China trade, they did not expect that Trump would impose such strong tariffs on Southeast Asian countries like Cambodia and Vietnam. With the tariffs now in place, the profits of Chinese companies exporting to the U.S. have decreased significantly, as some have nearly become non-existent. The more they export, the more they lose, and even their attempts to use transshipment trade have been blocked. Mr. Li, a manager in the U.S.-China foreign trade apparel industry, told Chinese media reporters, "I've been dreaming about Trump every day lately." The apparel factory, located in Yangtze River Delta, has been in the foreign trade business for 30 years, with a primary focus on U.S. clients. 2 years ago, during Biden's presidency, they began to worry about U.S.-China relations and started setting up subcontracting factories in Cambodia and Vietnam. When Trump took office on January 20th, Mr. Li began shifting orders that were originally produced in China to Cambodia and Vietnam, hoping to avoid potential tariffs imposed by Trump on China. In February this year, when Trump raised tariffs by 10%, the factory's profits were already low, and this cost was mainly borne by the suppliers. Mr. Li said, "Before the Chinese New Year in January, we worked hard to ship products, and customers were also stockpiling, fearing Trump would impose tariffs after taking office. He first raised tariffs by 10%, which we thought was bearable, as Trump had initially threatened to raise them to 60%. At that time, we were somewhat relieved. In early March, Trump announced an additional 10% tariff on Chinese products. Mr. Li said, "Another 10% feels like there's no profit left, but fortunately, the group has other profitable businesses." The company's founder decided to continue. From that point, they gradually moved orders to Cambodia and Vietnam. Mr. Li had to visit both countries every 2 or 3 days, believing that as long as production capacity was moved out of China, they would find a solution. On the day Trump announced the new tariffs, Mr. Li had just flown back to Shanghai from Cambodia, where he had arranged production. While on the plane, he learned that U.S. tariffs on Cambodia and Vietnam were as high as 49% and 46%, which left him both laughing and crying. This meant their investments in these two countries over the past 2 years were at risk of being lost. They had never expected Trump to impose such high tariffs on Southeast Asian countries as well. Mr. Li shared, "We looked at our costs and the suppliers' costs, and there was no way out. We can't lower them any further. Now, we can only negotiate with U.S. clients to see how we can resolve this." U.S. clients are unable to find better manufacturers, so they could not reduce costs. This apparel factory would not be easily abandoned by U.S. clients, but unless they set up a factory in the U.S. where the risks could be controlled, Mr. Li believes that establishing a factory in the U.S. is more suited to high-tech companies like TSMC. For traditional industries such as apparel, profit margins are low due to high labor costs in the U.S. But for China, what is truly alarming is not the sanctions or even the tariff increases, but the closure of loopholes for bypassing tariffs. If China's foreign trade can no longer change labels or alter the country of origin, that would be fatal. Trump's tariff bomb is not just a spur-of-the-moment decision. 3 hidden tactics are now becoming clear. First, supply chain strangulation, covering all 77 industrial categories in China. Strategic industries, such as solar panels and lithium batteries, face tariffs as high as 60%. Second, blocking transshipment routes, with countries like Vietnam and Mexico targeted with high tariffs at 46%, completely cutting off the backdoor trade route. Third, financial entanglement, with the US dollar settlement system carrying long-arm jurisdiction clauses, potentially subjecting third country trade with China to secondary sanctions. High tariffs will severely impact China's exports to the US. According to previous estimates by Bloomberg Economics, by 2030, tariffs of 54% on Chinese goods could reduce China's exports to the US by 90%. Macquarie Group has stated that if tariffs reach 60%, China's GDP growth rate could decrease by 2 percentage points. UBS has predicted that such tariff levels could halve China's annual economic growth rate. These forecasts were made last year. So, does China have any options? According to China Customs data, last year, China's exports to the US totaled over $500 billion, accounting for 16.4% of its total exports. China's main exports to the US include manufactured goods such as electronics, machinery, clothing, and consumer products. In contrast, the US exports to China mainly consist of agricultural products, energy, and high-value industrial products like aircraft and semiconductors. This is why the US is not afraid of a tariff war with the Chinese Communist Party. The US's strength lies in the fact that the products it imports from China are low-value goods, which can be easily replaced by imports from Vietnam and other countries. Especially after the US proposed a 46% tariff on Vietnam, the country has shown goodwill by announcing a zero-tariff policy towards the US. In contrast, China's imports from the US, such as high-tech products, energy, and agricultural products, are difficult to replace in the short term with goods from other countries. In fact, the scale and speed of the US tariffs and other measures on China during Trump's second term have exceeded market expectations and in some cases have far surpassed them. Chief economist for Morgan Stanley China, Xinji Chang, estimates that after the implementation of reciprocal tariffs, the weighted average tariff rate on U.S. exports to China will reach 65%, one of the highest tariff rates. He said, the ultimate drag on China's economic growth will surpass that of the 2018 to 2019 trade war. This means U.S.-China trade could nearly grind to a halt and China's GDP growth may be halved. In response, Xing Cheng suggested that China could accelerate the implementation of previously announced fiscal stimulus plans. If economic growth deteriorates quickly, new policies, such as increased support for childbearing or expanded trade-in programs for consumer goods, may be introduced in the coming months. However, these policies may only partially offset the impact of the tariffs. According to the WeChat account Chief Economist Forum, Chief Economist of Zhongtai International, Li Shunlei, stated that net exports will contribute 30% to China's GDP growth in 2024, with an expected negative contribution this year. As a result, China will need to gradually reduce its dependency on external demand, and expanding domestic demand will be a necessary path forward. Chief economist at GF Securities, Guo Lei, believes that the impact of the U.S. reciprocal tariffs on China's economy includes increased pressure on the growth rate of exports to the U.S., some drag on overall exports, and an approximate theoretical impact on nominal GDP of around 1 percentage point. Additionally, the decrease in exports will lead to lower capacity utilization, which will put pressure on product prices. Currently, exports are the only growth engine for China's economy. In 2024, China's trade surplus is expected to exceed 7 trillion yuan. However, due to factors such as the debt crisis, the real estate crisis, and weak consumption, China's economic recovery remains fragile. If the only remaining support, foreign trade, fizzles out, what will happen? On April 2nd, Kiki, who has been in the foreign trade industry for 8 years, posted a video on Douyin.
你以为房地产、基建、互联网是经济支柱，那你就错了。
If you think that real estate, infrastructure, and the internet are the pillars of the economy, you are wrong. The essence of China's economy is foreign trade. Real estate is just a derivative of foreign trade. The prosperity of real estate relies on foreign trade. The wealth earned by professionals is invested, and in a sense, wealth is being redistributed. Infrastructure and consumption are parasitic on foreign trade. Without the wealth created by foreign trade, infrastructure is just a house of cards, and the consumption is like water without a source. The internet economy may seem glamorous, but it is actually an extension of consumption, once again driven by foreign trade. Industries like biomedicine and new energy are all pawns in foreign trade. The core goal of these industries is to earn foreign exchange. Technological breakthroughs are essentially about competing for the global market. When foreign trade collapses, the economy collapses.